from Options Insight. How are you doing today?
Hey Brent, how are you, man?
I'm doing great. We were talking before that we got more new software from String Stuff, so I'll make sure that we got this thing right. If you can see or you hear us, let us know. You pop something in the chat there would be helpful. Looks like we are live and all good to go. So here we go. All right, I got confirmation. Let's roll. I'm gonna bring up my screen here. There's a bunch of interesting things going on, and where do we get started? We posted a little video up last night, and it's kind of funny how we talk about macro tourists, right? Now, I try very hard to not be a macro tourist and someone that focuses on options land, right? But starts talking about macro. So I try to stay that. Now you admittedly try to cover the macro piece, which is why you can add some more color.
I'm definitely a macro tourist, no doubt.
I just picture macro guys being like, "Why is the option guy over here talking about interest rates? How dare he?" But so look, let's just kick this off. I mean, in the video I just did quickly last night, we said, look, vol spiked obviously because of the CPI reading on Friday, and when interest rates shot higher, so did vol, and the VIX woke up. And basically what had happened is the market went from pricing a 50 basis point rate hike for Wednesday to 75 basis point rate hike, right? And that just sent sort of shockwaves through all asset classes. And so now we have this VIX expiration tomorrow. We've detailed that in our subscriber note quite a bit. But the first thing I want to start with, and you had some really good insights on this before we were going live here, was that even though the market dropped 8.5%, the S&P dropped 8.5% over the last 2 days, and we're kind of flat to down a little bit here. Vol is kind of like meh, right? It's like you can see here, I posted up a bunch of different metrics, volatility metrics. We got the volley index, we got the VIX index, we got the taildex index, and the skew are all plotted up here. And you can see that compared to March of 2020, none of those are making, major reaches higher. You could argue, I guess, just kind of last day or two, the volley index is. But, kind of what's your take here? Basically, vol is still just somewhat sleepy, right?
Yeah. So, I mean, if you compare it to credit spreads that are blowing out, you compare it to some of the stress in the bond market, various bond markets, right? Whether it's mortgage-backed bonds, whether it's emerging market bonds, like a lot of these are hitting levels that we haven't seen since 2020. But remember, we've mentioned this before, right? Like equities, it's been quite well flagged to equities that we are in a bear market. There's a lot of fundamental headwinds, and valuations need to go lower, right? And because of that, the street is kind of positioned for it, and it's been quite an orderly sell-off, right? Like, it's not like we did have a 4% down day yesterday, which is about as bad as it's got. But remember, March 2020, we were going limit down, and futures were just like not trading for ages, right? And circuit breakers being hit, and it was it was a bit of a shock, right? The market hadn't had months and months to digest it. I mean, there's an argument we've had since December to see the Fed turning hawkish. We've got various pundits coming out every single week telling us how the market should be 30% lower. It's hard to argue with a lot of the points that they're making, right? Even the Fed is kind of argued that that's the case, but just not in those words. So I just think the lack of surprise element to the sell-off, it's more surprising when the market squeezes 10% in 2 days and you're like, what the hell was that, right? Yep. And that's a bear market squeeze, and we all know it is. But the minute you give the market an excuse to sell off again and go to where it should be going, fair value, right, it gets there pretty damn fast. And vol's kind of already expecting that in mind. I mean, don't get me wrong, VIX has popped. Yes. But it was coming from quite a low base, right? It had almost got a bit too low, like getting within the low 20s kind of thing. So it's repriced to 30 odd. But that's why it's not breaking 40, because I just don't think it's a massive surprise to the market yet,
Yeah, we have our realized volatility metric up here, so I was just trying to check that. I mean, the 1 month is down. It did drop quite a bit over that last week, and obviously these last 2 days are going to feed into this model and pop that realized vol back higher, kind of as you mentioned. And I think that the part that is a little bit surprising here. I mean, we have VIX expiration. We talked about this again in our subscriber note, that there's a bunch of VIX call interest at 30 and 35 for tomorrow, and so if you're kind of in that Max Payne analyst sort of complex here, that there's no real reason for the VIX arguably to go necessarily over that level pre-Fed. And it's such a challenging thing to predict what the VIX expiration may do here, because you obviously have the front month VIX futures got to settle at the VIX index, and then you have the second month VIX future, which has to price in the FOMC, right? So there could just be a lot of just chop and swinging, I think, around as some of these positions roll off, and everyone kind of just like gets their hedges in place for the Fed, which is obviously going to be the main driver of volatility at the end of the week. If we look at this other slightly different metric here, this is the 10 to 30 day 25 delta implied volatility in the spiders. Is just another way to look at volatility, and you can see just how massive this implied vol move was back to March, as you were mentioning before. And it's also key to note there was a lot more things were much more extreme back then, even though things are seemingly pretty dire right now. I mean, you had negative oil prices, right? You had and all sorts of entities possibly going bankrupt, and the pandemic and the shutdown and this and that and the other thing. But I guess, what's still a little bit surprising to me is we still have yet to take out that Russian invasion high in the VIX. That to me is still a little bit, okay, we're not getting the 100 VIX, but we still just don't even have like a higher high at all, right?
Yeah, I agree with you. It is a little bit surprising, especially because the market has now broken 3,800. So it made new lows on the S&P, right? Until you make, when you test the low and you bounce like 10%, and then you retest that low, until you break that low, often vol doesn't perform. But then when you break that low and you do it in style, like a 4% down day, you would expect a reasonable vol reaction, right?
Yes.
Now, we've had a reasonable vol reaction in terms of where vol was 2 days ago versus where vol is now. It's just that we haven't broken that high in the high 30s, right? And whether we are or not, I think a lot of it might have to do with this kind of JP Morgan stuff on the downside, right? We know that there's a big put spread that's in the market expiring end of June quarterlies, which is providing the street with long optionality at 36.20 on the strike. So that's almost like your protection that the street's sitting on right now. So it doesn't need to chase vol higher when it's sitting on this lump of 20 billion notional worth of puts down there, and it's kind of using that vol to lean and sell shorter dated stuff and earn carry and fund, give protection to the instos who need it, kind of thing. I think once this expiry rolls off, and let's assume the 3,700 area is kind of where these puts are rolling off for this Friday, that kind of leaves the dealers with a load of long optionality 36.20 strike to end of month, which might mean that, we don't actually crash from there. We kind of start to gravitate towards 3,600, which becomes a bit of a long pin. And until that goes, we don't see an acceleration in the VIX, right? And I think that scenario is very possible. Yeah.
Yeah, I agree with that mindset, in that in general, we need the removal of put options, right, to open up a next leg down. And that JP Morgan put spread, which is 42.85, 36.20, those are the two legs. So dealers are essentially short the 42.85, but they're going to be long that lower strike to 36.20. So that's the put spread that you're talking about. And if you look at what happened in March, we had right here was there was some news out of China, right, that was a little bit of bullish, and then we went into the FOMC, and we had, again, a big options expiration in terms of a lot of puts expiring. And we had that big 10% rally. But to your sort of point, we pinned up, and we kept rising up into that end of month move, the quarter end move. And on that day of the quarter end move, there was a lot of volatility there when those strikes all got adjusted and rolled. And you could see that was really essentially the high of the quarter, basically, was as that JP Morgan position was rolled. And you can see just down from that, this blue line is the S&P, and we just kind of cratered all the way down. So to say that there is some kind of a complex here where you could lay off risk between, if you're a dealer or other vol trader, even, you could lay off risk between that today's expiration or this quarterly expiration, the monthly expiration and the quarterly expiration is a common thing. I've also been told that a lot of times too, they'll spread the risk out between the AM contracts, the SPX AM contracts, and then the PM contracts, right? So there's always this kind of spreading of risk that you're bringing up. And that, I think, again, ties into this idea of suppressing volatility. And from, again, kind of continuing this vein of thought, I mean, the FOMC is going to do whatever they do. We're always of the opinion, I think you and I kind of differ a little bit on this, on the impact of options expirations, but our basic, and I'll try to remove some of these lines here quickly to make it easier to see, but our basic playbook here is that when giant put positions expire, that provides rally fuel for markets. And kind of what's fascinating here is that we could get a 10% rally in the S&P, right? But we're only going to get back to where we were last week. So, yeah, maybe we get a put-induced rally on OPEX and all that, but I don't think this is the same thing that we had in December of 2018 or March of 2020, where, you get the bottom off of OPEX and some Fed stimulus, right? I think that it's clear that this time is different. However, there are still these big put positions, which I believe are a driver of an equities rally. You often have a little bit of disagreement with me in terms of the possible impact of that, but there are very large positions expiring on Friday. And
look, don't get me wrong, right? It's possible that, but I actually kind of feel that the flows are a bit different, or the positioning is a bit different to normal this time, right? So normally, in terms of short-dated optionality, right, you normally have a structure where dealers are short the downside, long the upside, okay? And often, as we approach expiry, that gets rolled into the next maturities, and so some of that kind of drops off, and you see these reactions in delta space, right? My only thoughts here are that when this expiry rolls off, because those June 30th downsides are such a big position and they're quite close to the money, they become like the dominant driver of dealer Greeks, basically, right?
Yes.
And also dealers are short the 43 upside strikes, basically. So if we actually get a rally, dealers go into short vol, not long vol on that particular end of month expiry. And if we get sell-off, dealers get longer vol, which is the opposite of what normally happens in index land. Now, obviously, we've got a whole load of other assets, we've got other indices, we've got other single stocks. But for me, S&P is the big driver, right? And I feel like the S&P dynamics right now are a bit different to normal. And so I would love to see a squeeze early next week, driven by the idea that the Fed only delivered 75 basis point hike, which the market might take dovishly, which I think is ridiculous, but it might do. Not dovishly, but just that it's in line, right? Because now people are scared of the 100 bip hike. But if we rally into early next week, I am slapping it because I think we're going much lower, right? And I'd be very happy to see that rally.
I would totally agree with you. I think we're of the same mindset. And I think there can be a lot of people. I mean, I get a lot of questions now of people looking for this OPEX rally because we're all, have that Pavlovian response now of big puts expiring, and then that oftentimes or is associated with the rally. And so I think we'd all love the chance. Hey, you get this rally up. The Fed. Look, this was another thing we said in the note that I want to get in first is that with the market dropping 8%, that does some of the work for the Fed, right? I mean, the equivalent reaction you have to have now, it's almost like it pulled forward the move, obviously, right? We've dropped now 8%, and so the Fed has to do something even worse to get us to drop another 8%. So even just coming in with a new expectation could be enough to say, okay, look, this thing is going to rally because vol is still high. Yes, it's not at record highs, but there is so much volatility in the system that even just sort of like an from the Fed where you go, okay, they just did what we thought they'd do, maybe enough for a rally because there is so much, this is the Van and charm effect, right? There is so much of that pent up positioning that's got to come off. And if we're not realizing volatility, then I think that implied volatility's got to come down, even though it's not at record high or whatever.
Yeah, no, I agree. Some of the sell-off is already priced in, but it's just that's that's why they leaked it, right? The Fed's been in blackout for the last week. Haven't been any Fed speakers allowed to talk, and so they've leaked it to the press. Wall Street Journal said 75 bips coming, and the whole market's repriced it in, right? So that's their playbook, right? So they kind of let the market digest it. So then when they do deliver the surprise hike, it's kind of already expected, right? So the market reaction, rather than being a sudden one-day event, gets spread over a few days of being priced in, which means the market impact is less dramatic, basically.
Yeah.
So that's what I think's happened. And that's why maybe we don't get a really violent move lower. We just get like a choppy bit of a bounce, then a bit of a sell-off, and we find ourselves gravitating towards 3,600 in 2 weeks' time, and we haven't actually puked that much. And not only have they delivered 75 bips, they priced in another 75 bips for the next month and another 50 bips for the September. And it's like, okay, terminal rates are like 3.5 or 4, and we're at 3,600, which was kind of the goal, it seems, right? Financial conditions tightening, trying to get the reverse wealth effect, all those things that they're trying to do and engineer. They need to see that market lower, but they just don't want to see it down 10% and everyone panics and craps themselves, basically. Right.
Yeah, I would agree with that. And so, someone here, Hank asked, do we dive tomorrow on end of day rally? I mean, I think it's Fed dependent. I'm assuming the Fed is not going to do much to try to upset the markets more. I think that they don't want to ever sort of give their speech and then see the market just drop 10%. So I think they try to jawbone things and say, hey, don't worry about it, guys. It's just a little raise here. And so the market will generally stabilize or rally after FOMC. You have this idea of event vol too, where options price in the worst case scenario, right, of the FOMC. And oftentimes they don't deliver on that worst case scenario. And so naturally, volatility, implied volatility, just comes down as the event passes, and it turns out to just be kind of a, again, not a big deal. And so we look for a rally kind of into Friday would be, one scenario. If the Fed does upset the market and the market crashes into Friday, then we would look, this is SpotGamma speaking, for a rally on Monday and Tuesday. Imran generally will like to say that he predicted a rally the day after it happens. I know that's what you like to do, but
I don't know when the rally happens, but I agree, like post FOMC, vol's coming down, right? Mm-hmm. Probably normally when vol comes down, that induces some sort of rally, right? But I just think the rally will be short-lived wherever it is, right? Yeah. So I don't see the rally getting back above 4,000, especially, right?
Yeah, and this is that 4,000 strike here. I mean, there's huge call interest and put interest, and a lot of that is going to shift off on Friday. So, I don't think that's levels in play really for into end of week, but crazier things have happened. So, I didn't mean to cut you off there. I just want to bring up that chart.
No, that was useful. Like I say, I just, for me, I think right now the fundamentals are in the driving seat, right? You have a bit of shenanigans on options. If we look at it, the reason the market has done what it's done in the last 3 days, it's got nothing to do with options, I don't think, right? It's got much.
No, I completely agree with you. And I think where that's why we're forced to start talking, where I'm forced to talk about macro probably a little bit more than is appropriate, is that I do see this window, though, where there's options expiration, right? And I think that the options market can invoke some pressure. And to your point earlier, if we get that rally and vol comes down, I think a lot of people are thinking that's going to be my time to finally reload on a bunch of puts, right? That is my time to sort of get back into some protection here, particularly knowing that there is that very dominant JP Morgan strike again into
the month. Spreads probably because you don't expect an explosive vol move, even if we do go back down, basically. Right? It's only post end of June that you might get a more explosive vol move, right? So the type of structures, if you do get a bounce, are going to be either put spreads or put calendars where you're selling that 30th of June stuff and you're owning longer dated stuff because you think the real volatility explosion comes off end of June, basically.
Right. That's a great point. You don't want to pay that volatility tax. And I would say someone was pointing out the NASDAQ here. I mean, this is as ugly could be, and I see a lot of people seem to be focused on. And I'm in this newsletter group where there's all these famous technicians, right? Market technicians, and I just kind of keep an eye on what they're doing. And everyone's they all point out this level, and I've heard it from some fundamental people as well, that basically the February pre-COVID high is like, I think where a lot of people are watching for. You go, okay, that starts to be more of like a reasonable value for all that is going on here. It's basically the move without all the stimulus that came. Do you kind of any thoughts on that longer term target?
Yes, I mean, I think that number comes in at around 3,400, doesn't it, or near there, right? So that would be a pretty sensible place for us to go on the S&P in terms of where a lot of people see valuations headed and the kind of re-rating that earnings need to have and all this stuff. I mean, often these things tend to overshoot. So I think it's going to be a function of, the Fed reaction function. It's going to be, does a move to 3,400 induce the Fed to pivot or make noises like they're going to pivot, or do they have to wait and see inflation data actually coming down, right? See, that's the big question, right? It's like in the past, anytime we've had a wobble, there's been no risk on inflation, and all they've cared about is, sorting out growth and not letting markets roll over too dramatically, right? Problem now is they're a bit handcuffed. So it's really hard to know how much stress we need in risk assets, and particularly stock markets and credit markets. Basically, credit markets tend to be more bigger driver for reaction function of the Fed, right? But how much stress do we need in credit and stock markets before the Fed just says, we're not waiting around to see inflation data? We know inflation's rolled over. We know that we have to stop the market from collapsing, and we're going to step in. No one's got to know where that level is. I suspect that level's somewhere near 3,000, but I have no idea. That's just that's a guess.
And, I mean, your point is spot on. I mean, you can't price basically anything until you know what interest rates are going to be. You can't measure future cash flows. You can't value them, right? And not only that, who wants to buy a lot of this stuff now if you know rates are going to go higher? That's the thing about the MBS market having trouble. Here's on the MOVE index. I mean, look at this jump in the MOVE index. For those of you who don't know, that's the at-the-money volatility of a bunch of treasury bonds, right? And I forget exactly which treasury bonds. Basically, it's the VIX. It's the bond VIX index. The difference being that this only measures at-the-money options as opposed to all options. At any rate, sorry, go ahead.
To your point, right? The move being back to March panic highs, no one having a bloody clue where rates are going, right? Some people think rates need to go above 5%. Some people think long-end rates need to be at 2% because we're heading into a recession. So the bid offer on where people see long-end rates is so bloody wide. How the hell do you value equity markets, right? No one's got a clue, right?
Right. And I think the scary thing from my perspective is that, and I don't want to get into politics here because that never ends well, but a lot of the policies here that are driving higher energy inflation and the like, there's a big political element of that doesn't seem to be sort of solving the problem. So you just have to go to demand destruction to solve inflation. And you're talking about, people heating their houses and eating and stuff. I mean, that's the stuff that's really surging. And that is that's the unfortunate part of the matter.
Talking to a friend of mine who runs a macro portfolio yesterday, and he was saying the best way to look for demand destruction is what oil prices are doing, right? If oil prices are not rolling over, we're not getting demand destruction yet, right? That's the reality, right? Until people stop wanting to drive around and pay whatever they're paying at the pump, the demand destruction isn't there. Okay, we've got a bit of demand destruction from like what we've seen from Target and some of the retailers, but people are still paying to get in their cars and go around, right? If you really want to see demand destruction, you're going to see that oil price roll over. And that almost is your indication that, inflation is done, right? Oil's gone from 120 to 90. We've had enough destruction. Now the Fed can slow down.
Yeah. Right? And I think to your point, I think the very easy time to buy equities here is just going to be when the inflation reading comes back down and you get, maybe it takes 2 prints, but there's going to be, I think, a big risk on signal through that where we're like, okay, it looks like the rate hiking is done. And that'll be the equity. The equity risk on signal. That'll happen too slowly and too late, right?
We get the CPI once a month, right? And the marginal changes in those CPI, they're not large enough but things will get priced in earlier, right? The market will make a decision on if inflation has peaked, and it will probably be driven by commodity prices, right? It will probably be driven by PMIs for growth rolling over. It'll be driven by what commodities are doing. And if you see both those things crashing together, commodities and PMIs, then the market will say, okay, and you'll see inflation break-evens crash. And that's like, okay, right, we know what we're going to see in the data, and we know what the Fed's going to do about it, basically. I think that stuff gets priced in way before we actually see the actual print. Yeah.
I would play devil's advocate with you there, because I think on Friday people thought that they knew what was going to happen here, and these are extraordinary times, right? And then suddenly it's like, oh, we don't know. But your point is your point is spot on. I just had a bunch of shots.
Tries to price shit in early, right?
Right.
I think that's what I'm trying to say. The market's
you're 100% right about that. Yeah.
Market's going to try and price it early, but there will be data points that surprise the market, right? So that was an example of a data point that surprised a fair amount of people who had thought inflation was peaking. And there was enough in that data to say, no, inflation is actually, but the smarter people, like, I don't know if you follow people like Jim Bianco, I'm sure, right? The people who've made the inflation call, who've got it right, who've looked at the right stuff, right? They know that inflation isn't slowing down the way that people are saying it is, right?
And this is the tricky thing. You know, a lot of these commodities you can use, and yes, if oil comes down, if gas prices come down, et cetera. These oil prices, as a lot of these macro guys will point out, these oil prices are surging with China basically, you know, offline at the moment, right? I mean, that's some of these crazy things that are happening. And they say if you take an inflation adjusted oil price, we're still nowhere near the equivalent high of 2008. Yeah. So
yeah, I mean, the reason why it was so firm in the face of China being basically shut down is US driving season demand hasn't waned, right? It's strong, yeah. OPEC spare capacity is nowhere near what people think it is. Libya has got some political stuff going on where there's blockades to their exports, so they've only got like 100K barrels a day output when they used to have like 1 million, right? So there's not the capacity sloshing around that people think there is, which is keeping the oil market ridiculously tight, and that's why prices are going nowhere. Yeah, I mean that may well change at some point, but the supply side looks ridiculously tight in oil. Yeah.
Right, and I think here in the U.S., I mean, now I'm an energy analyst, so I could put that on my resume. But I believe that the gasoline storage levels basically are at the lowest they've ever been heading into the summer driving season, which you're in London, so you probably don't understand how big of a deal that is for the U.S. where everyone just gets in their car and drives around all summer. So it's we'll see some higher prices.
Everything's so spaced out in the US, right? Like I can get from the bottom of England to the top of England in like 6 hours or whatever. And you know, for you guys, that's like a small drive.
That's right. Yeah, that's totally right. That's funny. Yeah. So I wanted to bring up one more, instrument here to look at, and this is the CME Liquidity Tool, and what we're looking at here is the E-mini depth of book, and we've shown this before. I think actually you and I have conversed about this before, and you could see that in September. I think a lot of this was interest rate driven when the Fed started talking about higher rates, and liquidity just evaporated. And we look at the price of the S&P today. I mean, we're swinging in 10-handle moves just on nothing, right? We're just flopping around by 10-handle S&P increments. What is it, do you think, that brings liquidity materially back to the market? I mean, do you have an opinion on that? It's kind of a curveball question, but I don't think that we'll get a strong bounce in markets until so much of what is going on right now is liquidity based, right? Who wants to buy not just equities, but who wants to buy, MBS and all these other things? This is a structural problem with the market.
Yeah, I mean, I think it's a function of just liquidity being drained out of the system, right? So they want that, right? They want less liquidity in the system. You've got the guys who analyze that. I think it's Cross-Border Capital talk about liquidity all the time and say how dramatically it's rolling over, right? And whatever measures that they've got a liquidity index that they've built that looks at various things. But yeah, that is a consequence of general liquidity being removed and risk appetite coming down everywhere. And if there's not risk appetite, there's not depth on the bid and offer, right. And that's what you're going to see basically.
Right. So the impact here, for most of you probably understand that, but just to be clear, that if you're a fund, right, and you got to liquidate because of a margin call, or you just need to get some risk on, you got to pay more price, right? You're going to push the S&P price more, the futures price more to get that equivalent liquidity. So that's particularly scary in an issue with the margin call where you just have to close out, right? Your bank or your PM or whatever is like, take these positions off, and you're just forced to trade. And that's why you get these cascading defaults. Generally, if you're buying and you want to put a position on, you can wait, right? You can mitigate some of your impact by waiting before you get that risk on. But in these situations where you get a forced liquidations, this is where that liquidity, I think, really, really hits. And that's where volatility can really gap higher. You get just a jump on vol. And this kind of ties into this question that somebody mentioned in here about, default rates. I mean, we haven't seen defaults. We mentioned this very briefly. And I don't know if those defaults are going to start coming. It seems like, the picture is deteriorating for a lot of people in the crypto space. And I wanted to talk to you about that quickly. But if we start to actually get credit defaults, I think that's where you get this explosion in the VIX, because if you think that there's going to be defaults, then you're going to start paying up for protection in a way that you haven't yet. We've not had default risk, anything material yet, even through the whole Russia situation, right? They've paid their bills and that's been okay. But, crypto kind of falling apart and some of these other more speculative companies, i.e. Peloton and the like, maybe that starts to come up as an issue here in the second half of the year. I mean, do you have any insights there before we move on?
I mean, credit spreads are repricing wider, right? I mean, I don't know what level would imply we start seeing a shitload of defaults, right? But I mean, clearly you look at a chart on credit spreads, it's leading the VIX, right? The VIX is nowhere near doing what credit spreads are doing, right?
Right.
So I think there is stress there in the credit market, and we're seeing it on screen. It was a similar story. If I look back to 2008 when I used to trade then, right? Credit moved way before equity folded, right? Credit blew up in 2007, right? That's where the stress was, right? In subprime and all that stuff. Equities didn't get the memo until well into 2008, right? So I don't know like I say, I think a bit of it is like positioning based, like the street's got a bit of downside. Yep. And maybe we suddenly find ourselves at 3,200 on the S&P and a load of instos come in to buy puts with a 2 handle, and all of a sudden the street's short again and we see a bid to vol. But right now in the sort of local vicinity, it seems to be that the street's got enough vol between here and mid 30s on S&P, and that's keeping a lid on equity vol, whereas credit doesn't have the same positioning dynamics and is more pricing to fundamentals, which are a worsening macro backdrop, a tightening Fed, financial conditions tightening, liquidity being withdrawn. All these things are being priced in the rates market probably more correctly than they are in the equity market, I suspect.
Yeah. I mean, these are good points. And I mean, on the chart here is junk bonds, and then the orange line is the municipal bond ETF, and I mean the moves are just, it's I look at charts like this and I say it is remarkable that the VIX has not broken out. I mean, I think we all have this narrative to explain it, but it still is pretty remarkable to me that that it has been that the volatility has been somewhat contained in the equity space.
Looking at these charts, because I was looking at these charts in my macro call literally earlier today, and the caveat I would make is they look dire. All of them look like they're back to March 2020 lows or thereabouts. But bear in mind that these bond ETFs have an interest rate component, right? Mm-hmm. So whereas rates went to 0 in 2020, and those credit things were still down there. So that weakness in these ETFs was because credit spreads were on the moon, basically, right? Now, we can get the price of that ETF down here, but with rates much higher, the actual credit component, the default risk component, is much narrower than it was back in 2020, because a large part of that weakness is due to the interest rate component, basically. So just
in the duration.
Yeah.
Yeah, that's a very valuable and pressing insight there. I mean, they're down for different reasons now is the point. And I look at that and I just see volatility, and you bring up some key points there. You have your volatility dashboard, I believe you like to show. If you want to try to bring that up quickly.
No worries.
I'm trying to monitor the chat here too. So if you have any questions, I've been trying to hit them as we go. If you have any tough questions for Imran, I would like to watch him squirm when he tries to answer them.
All right. So can you see that?
I can. Yeah, I'm gonna.
All right.
That went way more smooth than I thought it would. Nice transition there, right, everybody?
This is my funky new Vol dashboard, right? That I'm releasing at Options Insight. Still kind of working on it. So it's in beta, so people are free trialing it at the moment for the rest of the month. But the idea is to kind of pull in a load of vol data and vol metrics to help guide some decision making around what trades make sense. And even if it's not to necessarily do a trade, it's to get some insight into what the vol market's telling you, basically, right? So here we got pulls in spot, pulls in vol, pulls in skew, pulls in term structure. It also has a look at realized volatility. So this kind of bar chart here tells me what the daily moves have been over the last sort of 10 days or so. And then that green line just calculates what the realized vol is, basically, right? So I can see realized vols tracking a little bit under 30 on the S&P. Implies have spiked 9 vols in the 1 month volatility in the last week. That takes them to around 31. This is as of close of play yesterday. So you can see there's a decent amount of premium still. I mean, there's a bit of vol, I call it vol carry. So the implieds, even though we don't think the VIX is going up that much, the implieds are still tracking a little bit over realized, right? And if you compare that to kind of where that number trades, that vol carry number, it's in the 85th percentile. So that's suggesting vol's quite expensive in equities right now, or in S&P at least.
How far does that data go back?
Pardon?
How far does that data go back? 85 percentile?
Just a year.
Okay.
Yeah, it's quite
fair
short.
enough.
Yeah. And then you look here, this strategy compass. This is just like a little dartboard that kind of to try and tell you if you think we're in a sort of mean reversion type. Vol's a bit of a mean reverting asset, basically, right? So it's telling you spot's a bit beaten up right now. Vol's a bit expensive. So the type of trade that for the brave, let's be clear, the type of trade for the brave is kind of selling puts right now. If you want to fade that. Now, generally, the further you go out on the outside of this compass, it's quite, especially at the top half, it's risky. Basically, if you're fading spot move in an extreme when vol's high, vol's probably high for a reason, right? So it's quite risky when you do that. So generally, I'd want to see, I'd probably want to do put spreads if I was fading this, and sell put spreads if skew's not too expensive. But you can see here, skew was very, very cheap about a week ago. And then this move down has now 25 delta skew has jumped, basically, right? So, it feels like the VIX hasn't done much, but compared to where we were 3 days ago, 3 sessions ago, it's done quite a lot, right? So
yeah. I mean, the last 2 days just felt a lot different, I think.
Yeah.
Just watching things trade. There was a liquidity, a lower liquidity level, and just a lot more volatility, right? Much less of a bid, I think, than
but that's basically the idea. So that dashboard's a way of kind of getting all that data in one place, having a look at the stuff you need to look at to try and help guide option positioning and trading, right? And that's kind of my goal and what I'm trying to do. Yeah.
It's a really cool dashboard. You all try that out at Options Insight. You can hit him up at Options Insight on Twitter if you want to try it out. Joe Morgan conveniently told me about the HYGH, which factors out the interest rate. So here are the high yield bonds, I guess, without that interest rate factor that you were mentioning before, Imran. So you can see that it is performing quite a bit better, obviously, than
yes, nowhere near the March 2020 stress levels, right?
Yeah. And then I think last thing we want to cover here is crypto. I mean, it is a disaster. If you're looking for vol, that's where crypto has to offer nowadays. Coinbase,
where's that stock now?
That's down at 52. It's doing remarkably, I guess, well, I would say. They just said they're going to lay off 20% of their staff, or 18% of their staff. The big news, I guess, as of recent was Michael Saylor apparently moving positions in his wallets, right? Moving his Bitcoin around his wallets, which some say is a sign that he may liquidate. I mean, take that comment, throw it in the garbage, or comment on it. What are you watching here in the crypto space?
Okay, so in a nutshell, what I think on crypto. So I've been calling for this sell-off for ages, right? Partly because crypto is just another version of risk assets. All these liquidity dynamics we're going to hit that market too. We've had a few catalysts to make the sell-off happen a bit fast forward in crypto, and it doesn't have any of the kind of backstops or anything, right? It's a free market. It just fear and greed, take over, right?
Yeah.
So fear is definitely kind of taking over. Now, you had this Celsius platform, right? That was a crypto lending platform that basically froze withdrawals and said, you ain't getting your crypto out of here basically until next year, right? So that's what really spooked the market yesterday. And then the day before, the weekend, you had Ethereum 2.0 get delayed again, right? You had like this thing that they had to do called the difficulty bomb they had to drop, and they delayed it by 2 months to make sure nothing goes wrong. So a few things hit sentiment, and then this thing starts to cascade. People have to liquidate, and that's what's happening, right? So now these Celsius guys are liquidating some ETH, hitting the market. People are worried that Saylor's going to have to liquidate. There's a really good video on Blockworks where Jack Farley interviews Michael Cow, a smart converts guy. And he's done a lot of work looking at the MicroStrategy balance sheet and to see, where they're at, the capital structure, the convertibles they've issued. Are they going to have to liquidate? Where's their stress points and all that stuff? These bonds aren't maturing till 2025, right? So provided they can meet coupon payments, right, with their cash flow, they're all right. Yeah. So as long as the macro doesn't deteriorate so much that MicroStrategy aren't making any money to cover the coupons, and they don't need to liquidate a load of Bitcoin
Right.
to 2025, right? But the problem is, how markets are dynamic, right? Market starts to price in issues, and then MicroStrategy stock gets whacked, and then they might, things can happen. So it's not that obvious, but in theory, they're in okay shape. They're not the whale that is about to get taken to the woodshed.
Right.
Probably someone else right now. But I was having a target of 20K on Bitcoin and 1,000 on Ethereum. I feel like revising those targets down because we kind of touched those levels almost last night, right? And until equities bottoms out, I think crypto might bottom out a little bit before equities, but I don't think equities is bottoming out until maybe August, September time, which means, I don't think crypto's bottoming out yet, which means we're probably going to the mid-teens, probably like 15K on Bitcoin, and God knows where we're going on ETH, right? I wouldn't like to say, but maybe 800, something like that. Those that are in sight now, right?
It's horseshoes and hand grenades in this market. You just got to get somewhere in the, you could be within 10 or 20% of the bottom, and it's so volatile. It's good. But I have two comments on that. I think anytime the market knows your position is a bad thing. I think that may have mucked with some of the Elon stuff with Twitter. I don't know, but if you know that where specifically Saylor's priced and the things that can happen to get him to get them to have trouble, that's not an advantageous position to be in. Obviously the greatest, I think, positioning offsides that was forced was the Vixplosion or Volmageddon in January of 2018. I mean,
well, to that point, it's a slightly out there point, but think of pegs, right? Where pegs are coming under attack. So lately there's speculation that the Bank of Japan are not going to be able to keep up their yield curve control, right? And they were trying to cap their 10-year yields at 25 basis points, and they popped above that yesterday, right? So like 30 or something, right? And they've got a Bank of Japan meeting on Friday this week. So what would be funny to me would be FOMC does what they do, Vol comes off, market has a little relief rally, and then the Bank of Japan basically go, we're removing the cap to 50 bips, and all hell breaks loose, basically. Because if they do that, the bond market will collapse, the yen will catch a crazy bid, and I think stocks will dump, right? So,
and then no matter what the options market's doing, it won't matter. So
it matters. So,
I could take a vacation for
it's a big tail risk that's out there, and it's starting to get priced in the yen market, right? Like yen puts are catching a bid. You look at dollar yen, right? Dollar yen's been ripping. You would have thought the bid would be on dollar yen calls. Actually, the bid's for dollar yen puts, which is quite telling. It's telling you where the tail actually is, right? And that's of a sharp reversal in dollar yen on the back of that. Yeah.
I don't know if so give me the right symbol here. The thing that one that's extremely insightful, I think some of these macro guys have been talking about similar moves in the euro, right? Where that's also a tenuous situation, but that yen, the carry trade and everything tied to that is something that I don't fully understand all that well, but I do know enough to know that is a huge driver, and those flows are so large they would overwhelm whatever options positions there. I was caught off guard, not to rewind to the crypto conversation, but how closely these two trade. I haven't looked at this chart. This is the S&P and Bitcoin. I mean, it's amazing, how closely they trade, considering that Bitcoin is supposed to be this uncorrelated get out of the system asset class. It's just it's remarkable how.
Well, they have periods. I suppose they have little periods of decorrelation, but overall, the minute you get a load of institutional money punting this thing, then everything becomes more correlated, basically, right? I think that's it. So
and to that point, when you are getting margin calls, you're going to sell the most speculative garbage you can, and not to say that crypto's garbage, but the Bitcoin holding is going to get sold before your Apple or your energy.
You're going to get a load of haters now that you said Bitcoin.
I'm not Matt Damon, so not everyone can get so mad at me. I'm not as bad as that guy. Probably don't get the Matt Damon jokes, just utter silence. All right, that's fine. You didn't see the Matt Damon crypto commercials? No.
No.
Everyone's ragging on him because he was on, I think it was the Super Bowl, and he was like promoting one of the crypto exchanges about like.
Okay.
You never saw that commercial?
I never did. No.
You can look it up. It makes my joke much funnier. And uncorrelated, I mean, you know, I'm a bit of a gold bug, I'll admit that, and it's upsetting to me, but at least it is performing better than Bitcoin. I will say that.
But it's performing better than every asset class, not just Bitcoin, right? Bonds, stocks, except for general other commodities like oil.
Right, except for every other commodity. It's doing very well.
Ignore commodities, because don't think of it as a commodity. If you think of it as an FX, then it's not so bad. Yeah.
There it is. Fortune favors the brave. That is it. Thank you, Chilean Pepper. That's his commercial, which is, you know, so many celebrities showing the crypto stuff is just it's pretty amazing.
Yeah, have to Google that and watch that advert. I'm interested now.
We could if I was prepared, I'd bring it up here. But I'm unprepared, so y'all can check it out. Oh, there it is. Someone just put in SpotGamma support on point. I think that's Matt.
Someone's put the link on there.
Oh, bring it up. All right. We are approaching the top of the hour here, Imran. Thank you again for your time here. If people want to reach out to you, let them know how they can do that.
Sure. So it's at options_insight on Twitter. That's where I post a lot of stuff. I also have a YouTube channel, Options Insight. My website is options-insight.com. You can reach us on there, just on the contact page, or you can book like a 15-minute chat with the team. So all sort of ways to get a hold of me. But yeah, the goal is to really help people navigate these crazy swings in markets and teach people that options don't need to be scary. They can help manage risk as opposed to taking a ton of it, right? Which a lot of people feel like options do, basically. Yeah.
That's great. Thank you. And a lot of great threads recently from you on Twitter. So don't want to miss those ones. We at SpotGamma here, you can visit us and get a free 7-day trial if you go to spotgamma.com. We also have the academy.spotgamma.com. My picture's up here, but Imran is the man that walks you through everything from what is a stock and option all the way up to how to be a dispersion trader, right? Is that where it ends at? Not quite that. Not quite that advanced. That was a joke too. Don't expect to trade dispersion. We also set up this little page. This is the last thing I wanted to pitch y'all on here, but it is a freebie. If you go to the page, it's in the YouTube description. You can download a breakdown of all the options positions that are coming up and expiring on Friday, sort of how big the options positions are for each individual stock. So that link is in the YouTube description here below. So pop in your email and we will send you a download link for that spreadsheet. So with that, Imran, it's going to be an exciting few days. We'll look forward to hearing what you have to say. Maybe we'll pop on next week if there's real shock and awe out there and we can do another update. But thank you again, buddy, for taking the time to do this.
Cheers, Brent. Till next time, mate.
Take care, everybody.